In today's video, I'll be discussing consolidated financial statements, and the objective is going to be for you to know when to consolidate financial results versus when to use a simpler method of accounting like the cost method or the equity method of accounting. And as you'll see here in a minute, it all comes down to the amount of influence the parent has in a subsidiary. So the amount of influence and control the parent has in the sub will decide everything in terms of which accounting method to use in this case. And then after that, I'm going to walk you through an actual real life example of how to consolidate a balance sheet when you make an investment in a subsidiary. But before all of that, I want to walk you through a quick, funny example of why we consolidate financial results in the first place. So let's assume that you're trying to make a decision whether to invest in my family or not. So my family is a business, and you're trying to make a decision whether you want to invest in the Hannah family, my family, right? So you come in and you look and you find that there is Bill, this is me, my brother, and my dad. We all have our assets and income, right? So the first question that comes up is, if you do business with the Hannahs, is it easier to look at standalone financial statements, or is it going to be easier for you to look at a combined set of financial results for the whole household, right? And the answer is easy. It's easier for you to evaluate a business or a family in this case by looking at the combined results, right? That's going to be easier for you than looking at individual set of financial statements. Then the second question is, what if in the standalone income includes selling to each other? What that means is that what if in the $100 income that I have here, Bill has $100 in income, what if the $100 includes $20 income from selling to my dad, right? So it's going to be hard for you to know whether the income includes inter-company or inter-family activity in this case. But when you look at the combined set of results, then there is elimination of inter-company or inter-family in this case. So that's when it's easier for you to look at a combined set of financial statements. So this is just a quick example of why we even consider consolidating financial results in the first place. And that's why when you look at a set of financial statements for a publicly held company, then you find that they consolidate the investment based on this criteria here. So this criteria here decides when to consolidate the financial results. So let's go through this criteria and explain it based on the amount of influence. But before jumping into that, if you're new to this channel, welcome. If not, welcome back. My name is Bill Hanna. I'm the financial controller. And this channel is all about giving you the summary of my experience over the last decade and a half working in accounting. I do this here in the YouTube channel and also on my website through blog posts and helpful online courses. I'm going to leave a link down below, so go ahead and check that out as well. So jumping here into the matrix of deciding when to use consolidation versus when to use a simpler method of accounting, you'll see that it comes down to the ownership percentage and the amount of influence and control the parent has in a subsidiary. So the first level here, or the lower level, is that if you own less than 50% and you have no significant influence, the parent has no significant influence in the operation of a subsidiary or the investment company, you'll be using the cost method of accounting, which is then broken down. If you have fair market value available, then you'll be using the marketable securities rule. And this is an example of a publicly held stock. So this is a stock that trades on exchange and you have fair market value available, then you'll be using the marketable securities rule. If you have no fair market value available, so say you're investing in a private company and you have no fair market value, you'll be using the cost method of accounting. You can go ahead and look this up online. It's a pretty simple method of accounting. And today's video is focused on consolidated financial results. For the cost method, this is a method you can look up online. Okay, so this is if you have less than 50% ownership. What if also you have less 50% of ownership, but you do have significant influence over the subsidiaries or the investment company's operations, right? So if you do have significant influence, and you can look that up online, there are criteria that are dictated by US GAAP, what significant influence means. But basically, if you decide that there is a significant influence in the operations of the investment company, then you'll be using the equity method. And in the equity method, you'll be recording the investment at cost, but then you'll be recording the increase or decrease in that investment on the balance sheet based on the investee's income or loss, right? So every year or every accounting period, you look at the amount of net income or loss the investee has and multiply that by your investment percentage or ownership percentage, and that's in that company, and then record an increase and decrease to the asset that you record in the balance sheet, right? So The equity method is obviously slightly more complex than the cost method, and that exists when you have significant influence. These rules are under US GAAP, but also IFRS rules are very, very similar. So we have less than 50%, but you have significant influence, you'll be using the equity method. Now, the next level is going to be control. So when you have control, and this usually is evidenced by having more than 50% ownership in the investment company or the investees. So if you own more than 50%, typically that dictates control, right? But also you could own less than 50%, but also that have control if you own the majority of the voting stock, for example. So if you have control, whether or not you own 50%, maybe you own 49%, but you still have control. But typically control exists when you have more than 50% ownership in the investment or the investee. Okay, so that's when you consolidate. So consolidation implies that you're going to be recording a cost. So you're going to be recording the investment at its cost. And we'll go through an example in a minute here, recording a cost, and then you're going to combine at year end. So you're going to combine the income statement and the balance sheet at year end, and you will eliminate intercompany transactions. And that's the example we'll go through here in a minute. So this is a quick matrix for you to kind of a cheat sheet for you to know when to use the cost method, equity method, and consolidation. Now let's jump through an example of how to consolidate a balance sheet when you make an investment in a subsidiary. All right, so walking through an example of a consolidated balance sheet. So the example that we have today is a parent company acquired 100% of a sub on 12/31/2019 for $2,000. Now, prepare the group balance sheet on the acquisition date and on 12/31/2020. So basically, they're asking you to do the combination on the acquisition date and then again 1 year later. So this will give you kind of a picture of what happens after 1 year from the acquisition date. Okay, so let's go through it. And as we go through it here, we'll write here some notes into the things that we have to do. So when we look at the balance sheet for the parent and the sub on the acquisition date, we have a standalone balance sheet for the parent and a standalone balance sheet for the subsidiary. And we'll go here and write down the combined results. So for the parent, we have investment in sub, $2,000, which is pretty easy, right? So we bought the company for $2,000. We record an investment in the sub for $2,000, debit to investment, credit to cash. Pretty simple, right? So that's for the parent, investment in sub. Now we have other assets of $3,000 for total assets of $5,000, liabilities, share capital, retained earnings, and then we have total liabilities and equity, which is always going to equal assets, $5,000 for total assets, $5,000 for total equity. For the subsidiary, they have their own standalone balance sheet. So let's go ahead and create the combined or the group results. So the first step is that we're going to eliminate. So we're going to eliminate the investment in sub. So when you combine the group, this will be here 0, right? Because the idea is that when you acquire or when you have 100% ownership in the sub, now instead of recording an investment on a group basis, you're going to combine the assets and liabilities, right? And so when you own the assets and liabilities, that's always almost equivalent to owning an investment in the sub. So you're going to eliminate investment in the sub, and then you're going to combine the assets and liabilities of the sub. So the first step is going to be eliminate investment. That's going to be your first step. And then you're going to combine your assets and liabilities. So for other assets, you have 3,000 plus 2,400. That's going to be 5,400. And then when you add up total assets, it's going to be 5,400. Okay. Now, when you get to liabilities, as we said, we're going to combine assets and liabilities. So second step is going to be combine assets and liabilities. So liabilities, we're going to add up straight addition, 800 plus 400, that is 1,200. Share capital, you're going to eliminate the subsidiaries' share capital. And you're going to only take the parent, 2,000. And that's the same reason as we said before for eliminating the investment in the sub. We're only considering the assets and liabilities, right? We don't care about equity and investment. That's why we eliminate the investment and the share capital of the actual subsidiary. So eliminate sub share capital. Okay, now we've added up share capital, retained earnings. So when we get to retained earnings, we'll talk about this in a second. Retained earnings is going to be a plug. So plug retained earnings. So 4 steps so far: eliminate investment, combine assets and liabilities, eliminate subsidiary share capital, plug retained earnings. And you'll plug retained earnings by saying, okay, total liabilities and equity is going to always equal total assets. So total assets is 5,400. So you put this down below here, and then you can subtract out the share capital and liabilities and come to the amount of retained earnings that will be plugged into here. So when you subtract out 1,200 and 2,000 from the 5,400, you'll get 2,200, which, if you notice, is equal to the retained earnings of the parent, which is no coincidence because retained earnings is an accumulation of the previous net income. And in this case, you're almost ignoring the retained earnings of the subsidiary and you're only recording retained earnings of the parent because you've already recorded all the assets and liabilities of the company. And so the total here of share capital and retained earnings is 4,200. And that's how you combine the balance sheet. And let me just check here quickly. The math checks out. Perfect. Okay, so this is the combination on the acquisition date. Now let's look at it a year later, which is going to be very, very similar process. But when you look at it a year later, retained earnings is going to change. It's going to still be a plug, but here you'll see that you're getting a retained earnings share in the year. So that it has been 1 year of operation, and now you're going to pick up in the combined results the share of retained earnings in that year that you've been investing in this company. So when you come here to combine them, it's going to be the same thing. We said eliminate the investment, so it's going to be 0. You're going to add up combined assets and liabilities, combined assets, so 3,800 plus 2,900, that's going to be 6,700. Now total assets is going to be obviously just the 6,700. And then we said we're going to also combine liabilities, combine assets and liabilities. So combine liabilities, 1,000 plus 600 is 1,600. For share capital, we said that we're going to eliminate subsidiary share capital. So share capital here is 500 for the sub, eliminated. You have 2,000 combined. And we're going to leave retained earnings here blank. And we're going to plug it again at the end. So let's come down here and said total liabilities and equity is going to always equal total assets. So 6,700 will go down here. Okay, and now we can work our way backwards into retained earnings, which when we subtract out liabilities and share capital, will come to 3,100 in this case. Okay, now as you can see, the observation that you'll make here is that retained earnings, although we plugged it, it came out to 3,100. So if you look at 3,100, how that's increased from the parent has 2,800. So the difference is 300. That 300 difference that you see between 3,100 and the parent is exactly equal to the increase in retained earnings in the sub. So look at the sub has 1,800 here in retained earnings and had 1,500 here a year later. So in essence, what you're doing here is that you're picking up 300, adding it to the 2,800, and that gives you the retained earnings for the combined company. You can do it by plugging, but I'm just explaining to you why the 3,100 is 3,100 is because it's the 28 plus an increase of 300 in the subsidiary from 1,800 here to 1,500 a year before. Okay, so this is how you combine the financial statements. If you have any questions, go ahead and leave any question you have in the comment section below, and I'll see you in the next video.